Hello everyone, welcome to the 212th episode of me learning how to trade in Forex. In the last episode we went through 9 Forex trading tips, so ensure your personality fits the style of trading you undertake, choose a reputable broker and spend time researching the differences between the brokers, be consistent with the methodology you choose to trade and ensure it's adaptive. Your trading system should keep up with the changing dynamic of the market. Conflicting information can be seen when looking at charts in different time frames. So for example, it could show a buying opportunity on a weekly chart, whereas on a daily chart it could show a sell signal. So to fix this, I guess, synchronize the two time frames to ensure that both charts give out the same signal. So both weekly and the daily chart gives the buy signal. Expectancy is a formula for determining how reliable your trading system is. So go back in time and measure all your trades that were winners and losers to determine how profitable your winning trades were versus how much your losing trades lost. So your expectancy is equal to the percentage win times by your average win amount minus your percentage loss. That should be a percentage loss, not whatever that is. Percentage loss times by your average loss amount. Your expectancy outputs how much you could win per trade. So before trading, determine the level of risk that you're comfortable taking on each trade and how much can realistically be earned. A risk to reward ratio, not ration, ratio helps traders identify whether they have a chance to earn a profit over the long term. Use stop loss orders to cap losses, focus on your trades and accept small losses, follow your trading plan, and on the weekend when the markets are closed, study weekly charts to look for patterns or news that could affect your trades. Learn to be patient and objectify your trades by grabbing a chart and listing out all the reasons for the trade. So this includes the fundamentals that sway your decisions, mark the chart with the entry and exit points, and make any relevant comments on the chart, including emotional reasons for taking action. Then we've got strategies for part-time Forex traders. So analyze the correlation between currencies when choosing a pair. When choosing a currency pair to trade, conduct analysis on these pairs and the fundamentals of each currency, and understand the drivers of your currency pair. So that's that. Now on to 3 simple strategies for Euro traders. EUR traders speculate on the strength of the Eurozone economy compared to its major partners. The relationship between the Euro and the USD marks the most liquid Forex pair in the world, with tight spreads and broad price movement that supports a continuous flow of profitable opportunities. While there are many ways to trade the Euro-USD pair, 3 simple strategies have been consistently effective. These can be executed by Forex traders of all skill level. Newer participants can reduce position size to control risk, while experienced players can increase the size to take full advantage of the opportunities. So key takeaways: the Euro-USD currency pair is the most liquid Forex pair in the world. Euro-USD transactions represent approximately 1/4 of all Forex trades. 3 basic ways to trade Euro-USD can be executed by Forex traders of all skill levels. Newer traders can reduce position size to control risk. More experienced players can increase position size to take full advantage of profit opportunities. So number 1. Buy the pullback or sell the pullback. The Euro-USD trend thrusts in both directions and carries the price from one level to another in a positive feedback loop that can generate considerable momentum. The Euro-USD trend thrusts in both directions and carries the price from one level to another in a positive feedback loop that can generate considerable momentum. However, this rapid movement tends to fizzle out when the supply-demand equation shifts, often trapping latecomers in positions that will be executed for losses when the currency pair reverses and heads in the opposite direction. The pullback strategy takes advantage of this counter-trend movement. It involves identifying significant support or resistance levels that can end the price swing and reinstate the initial trend direction. These levels often come at prior highs or lows, as well as key levels defined by Fibonacci retracements, moving averages, and the inception point of the original thrust. Can generate considerable. However, this rapid movement tends to fizzle out when the supply-demand equation shifts. The EUR-USD trend thrusts in both directions. So both up and down, and carries the price from one level to another in a positive feedback loop. And carries the price from one level to another in a positive feedback loop that can generate considerable momentum. However, this rapid movement tends to fizzle out when the supply-demand equation shifts. This rapid movement tends to fizzle out when the supply-demand equation shifts. When the supply-demand equation shifts, often trapping latecomers in positions that will be executed for losses when the currency pair reverses and heads in the opposite direction. So, which often traps latecomers in positions that will be executed for losses that will be executed for losses when the currency pair reverses and heads in the opposite direction. When the currency pair reverses and heads in the opposite direction. The pullback strategy takes advantage of this counter-trend movement. It involves identifying significant support or resistance levels that can end the price swing and reinstate the initial trend direction. Identify significant support or resistance levels that can end the price swing and reinstate the initial trend direction. It involves identifying significant support or resistance levels that can end the price swing and reinstate the initial trend direction. Okay, end the price swing and reinstate the initial trend direction. These levels often come at prior highs or lows, as well as key levels defined by Fibonacci retracements, moving averages, and the inception points of the original thrust. So these levels are often come at prior highs or lows, as well as key levels defined by Fibonacci retracements, as well as key levels defined by Fibonacci retracements, the moving averages, and the inception point of the original thrust. Euro USD trend thrusts in both directions and carries the price from one level to another in a positive feedback loop. So it goes up to down, and then down to up, and then up to down again. This rapid movement tends to fizzle out when the supply-demand equation shifts, which often traps latecomers into positions that will be executed for losses when the currency pair reverses and heads in the opposite direction. Right, okay, so the pullback strategy involves identifying significant support or resistance levels that can end the price swing and reinstate the initial trend direction. These levels can often come at prior highs or lows, as well as key levels identified by Fibonacci retracements, the moving averages, and the inception point of the original thrust. So identifying when the reversal happens, and then you can not become a latecomer and get trapped in a losing position. Buy the breakout and sell the breakout. The Euro USD pair often grinds back and forth within confined boundaries for extended periods, setting up well-defined trading ranges that will eventually yield new trends higher or lower. The Euro USD pair often grinds back and forth within confined boundaries. Grinds back and forth within confined boundaries. for extended periods. Setting up well-defined trading ranges that will eventually yield new trends higher or lower. Eventually yield new trends higher or lower. So does that mean breaking through the trading ranges? So, which sets up defined trading ranges. Patience during these consolidation phases often pays off with low-risk trade entries when support resistance finally breaks, giving way to a strong rally or sell-off. Good timing is needed to take full advantage of this simple strategy. Enter too early and the range could hold and trigger a reversal. Enter too late and you'll risk executing well above new support or well below new resistance. It's often a good idea to reduce timing risk by opening a partial position when the pair breaks out or down and adding to it on the first minor retracement. Patience is needed to trade entries when the support or resistance level breaks. Good idea to reduce timing risk. To reduce timing risk, open a partial position when the pair breaks out or down and adding to it on the first minor retracement. Open a partial position when the pair breaks out or down and adding to it on the first minor retracement. Fast fact, the USD is the world's most dominant currency. As of 2019, it's on one side of 88% of all Forex trades. The euro is the next most traded and is in 32% of all global trades. Enter narrow range patterns. Euro USD will often rise or fall into a significant barrier and then go back to sleep, printing narrow range price bars at lower volatility and raise apathy levels. Euro USD will often rise or fall into a significant barrier and then go to sleep, printing narrow range price bars at lower volatility and raise apathy levels. Coincidentally, this quiet interface often marks a powerful entry signal for a breakout or breakdown. Using this strategy, a trader enters the position within the narrow range pattern with a tight stop in place in case of a major reversal. This setup often prints an NR7 bar, which marks the narrowest range price bar of the last 7 days. Originally observed in the US futures market in the 1950s, this powerful but simple pattern predicts that price bars will expand in a sizable breakout or breakdown. It's also a low risk entry because the stop loss can be set very close to the entry price. USD will often rise or fall into a significant barrier and then go to sleep. Will often rise or fall into significant barrier and then go to sleep. So consolidate basically, printing narrow range price bars. So the highest price has been sold and lowest price has been bought is very close to each other. That lower volatility and raise apathy levels, which gives out narrow range price bars. That lower volatility and raise apathy levels. Coincidentally, this quiet interface often marks a powerful entry signal for a breakout or breakdown. This quiet interface often marks a entry signal for a breakout or breakdown. Using this strategy, a trader enters a position within the narrow range pattern with a tight stop in place in case of a major reversal. Trader enters position within the narrow range pattern. The trader enters the position within the narrow range pattern, and with a tight stop loss in place in case of a major reversal. With a tight stop loss in place in case of a major reversal. This setup often prints an NR7 bar, narrow range 7 bar, which marks the narrowest range price bar in the last 7 bars. Originally observed in the US futures market in the 1950s, this powerful but simple pattern predicts the price bars will expand in a sizable breakout or breakdown. It's also a low risk entry because the stop loss can be very close to the entry price. So this setup prints an NR7 bar. This setup often prints a NR7 bar, which marks the narrowest range price bar of the last 7 bars. Originally observed in the US futures market in the 1950s, this powerful but simple pattern predicts the price bars will expand in a sizable breakout or breakdown. So this pattern predicts that price bars will expand in a sizable breakout or breakdown. Will expand in a sizable breakout or breakdown. It is also a low risk entry because the stop loss can be set very close to the entry price. So the stop loss can be set very close to the entry price. What is a Euro USD? Euro USD is a currency pair, represents the relationship between the two most highly traded currencies in the world. In terms of value, a quote for Euro USD will indicate the amount of USD needed to buy 1 euro. Yep. What will affect the value of the Euro USD? The Euro USD currency pair exchange rate can be affected by economic and political conditions in the US and the countries of the Eurozone. Actions by the Federal Reserve and the European Central Bank can influence the spread, so can monetary policy of countries within major economies such as Germany. To trade effectively, it's important for traders and investors to stay on top of what's happening on both sides of the Atlantic. So pay attention to both the Federal Reserve and the European Central Bank. Can technical analysis help those trading the Euro USD? Both fundamental analysis and technical analysis can inform forex trading investments decision making. Fundamental analysis involves using economic data to set entry and exit points. Technical analysis uses chart patterns of price action and associated technical indicators to time executions. Technical analysis may be extra helpful for those who trade actively in high liquid, fast moving forex market. However, you're not limited to one type of analysis or the other. So use both. Bottom line, as described above, novice and experienced Euro traders can execute the 3 simple but effective strategies that take advantage of repeating price action. Equity traders can also apply these techniques with currency shares Euro Currency Trust, which tracks the forex pair in real time. Leveraged and inverse ETFs, exchange traded funds, can also be traded if you have the skills needed to manage the additional risk. ProShares Ultra Euro offers double long side exposure. However, it's thinly traded with an average volume of 20,106 as of June 1st, 2022. ProShares Ultra Short Euro offers equal leverage to short sellers and greater liquidity. Offers greater liquidity. Its average trade volume was 90,482. Don't really know what ProShares Ultra Euro and ProShares Ultra Short Euro is. Offers equal leverage to short sellers and greater liquidity. Its leveraged trade volume was 90,482. Okay. On to the next one. Currency carry trades. The carry trade is one of the most popular trading strategies in the currency market. Putting on a carry trade involves nothing more than buying a high-yielding currency and funding it with a low-yielding currency. It's similar to the age buy low, sell high. A currency carry trade is a strategy that involves borrowing from a lower interest rate currency to fund the purchase of a currency that provides a rate. I'm assuming that says provides a higher rate. Trader uses strategy in an attempt to capture the difference between the rates, which can be substantial depending on the amount of leverage used. Carry trade is one of the most popular trading strategies in the Forex markets. Carry trades can be risky because they're often highly leveraged and overcrowded. Carry trades can recognize profit or loss on the value appreciation or depreciation of the currency pair, in addition to potentially earning interest. So the carry trades. Two popular carry trades in 2023 involve buying currency pairs like the AUD JPY and the NZD JPY. The interest rate spreads of these currency pairs can be high, but they can vary from day to day. The first step in putting together a carry trade is to find out which currency offers high yield and which offers a low yield at a particular time. So, first step to carry trade is to find out which currency offers high yield and which currency offers a low yield at a particular time. The interest rates for the most of the world's liquid currencies are updated regularly on sites like FX Street. You can mix and match the currencies to the highest and lowest yields with these interest rates in mind. Fast facts: interest rates can be changed any time, so Forex traders should stay on top of them by visiting the website of their respective central banks. Interest rates can change at any time, so visit the website of your respective central bank to find out. New Zealand and Australia have the highest yields on our list, and Japan has the lowest, so it's hardly surprising that AUD JPY, so trading JPY for AUD, is often the poster child of the carry trades. Currencies are traded in pairs, so all an investor has to do to put in a carry trade is to buy NZD JPY or AUD JPY through a Forex trading platform with a Forex broker. The JPY's low borrowing cost is a unique attribute that's also been capitalized by equity and commodity traders around the world. Low borrowing cost. Investors in other markets have begun to put on their own versions of the carry trade by shorting the yen and buying the US or Chinese stocks. This has fueled a large speculative bubble in both markets, and it's why there's been a strong correlation between the carry trades and stocks. Shorting the yen, buying the US or Chinese stocks. Strong correlation between the carry trades and stocks. Correlation between carry trades and stocks exist. So the mechanics of earning interest. One of the cornerstones of carry trade strategy is the ability to earn interest. The daily interest is calculated like this. So daily interest is equal to interest rate for the long currency minus interest rate for the short currency divided by 365 days times by notional value. So daily interest is equal to interest rate of the long currency interest rates of long currency minus interest rate of short currency. Divide by 365 days. So divide by 365 days times by notional value. Imagine the currency you're going long on has an interest rate of 4.5%. Currency you're short on has an interest rate of 0.1%. So the currency you're buying has an interest rate of 4.5. Currency you're selling has an interest rate of 0.1. Assuming a notional value of $100,000, you can compute interest as 0.450 minus 0.001 divided by 365 times our 100,000, which is $12 per day. The amount won't be exactly $12 because banks will use an overnight interest rate that will fluctuate on a daily basis. Important, this amount can only be earned by traders who are long on AUD/JPY. Interest is paid every day to those who are fading the carry or shorting AUD/JPY. Interest is paid every day to those who are fading the carry or shorting AUD/JPY. This amount can only be earned by traders who are long on AUD/JPY. Interest is paid every day to those fading or shorting. What? Interest is paid. Oh, so you have to pay interest if you're shorting the AUD/JPY. Oh, right, I see. So yeah, if you're shorting it, then you have to pay interest. Why is this strategy so popular? The returns on the straight carry trades aren't very large for most people, but these trades are often executed with leverage. Even the use of 5 to 10 times leverage can make that return extremely extravagant in a market where leverage is as high as 200 to 1. Investors may also favor carry trades because they earn interest revenue even if the currency pair fails to move 1 penny. This often isn't the case because Forex trading typically entails currencies with fluctuating values, but there's potential to earn both interest revenue as well as capital appreciation with these types of trades. Investopedia, 9.5% minus 14. What is this chart showing? Gone up, gone down. Because Forex funding trading typically entails currencies with fluctuating values, but there's potential to earn both interest revenue as well as capital appreciation with these types of trades. Yep. Low volatility, risk friendly. Carry trades also perform well in low volatility environments because traders are more willing to take on risk. Carry traders are looking for the yield. Any capital appreciation is just a bonus. So most carry traders are perfectly happy if the currency doesn't move 1 penny. The big hedge funds that have a lot of money at stake are perfectly happy if the currency doesn't move because they still earn the leveraged yield. Carry traders who essentially get paid while they wait as long as the currency doesn't fall. Traders and investors are also more comfortable taking on risk in low volatility environments. So carry trades work well in low volatility environments as carry traders are just looking for a yield. Any capital increase is a bonus. Therefore, carry traders are happy if the currency doesn't move. If the currency price doesn't move. As long as the currency doesn't fall. So, as long as the currency price doesn't fall. Carry traders will essentially get paid whilst awaiting as long as the currency price doesn't fall. Traders and investors are also more comfortable while taking on low risk in a low volatility environments. Central banks' interest rates. Carry trades work when the central bank either increase interest rates or when they plan to increase them. Money can be moved from one country to another with a click of a mouse, and big investors aren't hesitant to move their money around in search of not only high but increased yield. So, carry trades work when central banks are either increasing interest rates or planning to increase them. Money can be moved from one country to another with a click of a mouse, and big investors aren't hesitant to move their money around in search of not only high but increasing yield. The attractiveness of a carry trade isn't only in the yield but also in the capital appreciation. The world notices when a central bank is raising interest rates, and there are typically many people piling into the same carry trade. This pushes the value of the currency pair higher in the process, so there's going to be more demand for that currency, so the price increases. The key is to try to get in at the beginning of the rate tightening cycle and not at the end. So, key is to get in on the trade at the beginning of the rate tightening cycle and not at the end. The profitability of carry trades comes into question when the countries that offer high interest rates begin to cut them. The initial shift in monetary policy tends to represent a major shift in the trend for the currency. The currency pair must either not change in value or appreciate for a carry trade to succeed. Profitability of carry trade is questioned when the countries that offer high interest rates begin to cut them. The currency pair must either not change in value. The currency pair must either not change in value or appreciate for a carry trade to succeed. Alright, or appreciate. So go up in value or appreciate for a carry trade to succeed. Currency pair must either not change in value or appreciate for a carry trade to succeed. Foreign investors are less compelled to go long on a currency pair and are more likely to look elsewhere for more profitable opportunities when interest rates decrease. Demand for a currency pair wanes and it begins to sell off when this happens. This strategy fails instantly if the exchange rate devalues by more than the average annual yield. Average annual yield. This strategy fails instantly if the exchange rate devalues by more than the average annual yield. For more profitable opportunities when interest rate decreases. Demand for the currency pair wanes and begins to sell off when this happens. So, if the currency pair begins to get sold off, then that means there's going to be more supply than demand, so then its value is also going to decrease. So, which causes the currency pair to decrease in value. So, then you're not making any interest on the carry trade, and your capital is also depreciating. So, that's a double loss right there. Demand and begins to sell off. This strategy fails instantly if the exchange rate devalues by more than the average annual yield. So, this strategy fails instantly if the exchange rate devalues by more than the average annual yield. Can't type. This strategy fails instantly if the exchange rate devalues by more than the average annual yield. Cool. Fast fact. Losses can be even more significant with the use of leverage. The liquidation can be devastating when carry trades go wrong. Okay, I'm going to leave this episode here then, so in the next video we're going to carry on with central bank risk. Bye bye.